Hello and welcome to the Kingsview Investment Strategies Q2 Market Update and Portfolio Review. I'm Scott Martin, Chief Investment Officer of Kingsview Asset Management. Joining us today, a familiar face, Paul Nolte, Senior Vice President and Portfolio Manager at Kingsview Investment Strategies. Paul, busy schedule as you usually have. Thank you for taking some time again to join us here for our quarterly review piece. Gosh, I mean, it's great to have you here because there's a lot to talk about as usual. Here we sit early April talking about the markets, the economy, the economic data that's out there. Let's talk a little bit about the year that has now been, or becoming, let's say, given what we saw and we talked about last with you at the end of last year, given the market volatility, these fears of a recession, the Fed being on the wrong side of the curve here. Talk to me a little bit about what's gone on so far in your mind as far as these first 3 months that have been completed so far in 2019.
We've had a great year so far this month, or this quarter. And really, when you take a look at it, it is all emanated from the Fed. We were talking last year about a Fed that was going to be raising rates, normalizing interest rates, normalizing their balance sheet. And we came into this year pretty certain that we were going to get at least 2 more rate hikes. We were going to get some more runoff of their balance sheet. And then we had Christmas Eve, and as we talked about very early last year, we saw the markets turn around on the Fed pivot, and the Fed has come out demonstratively ever since, and every opportunity that they've had to talk about being very patient, looking at the economic data, and maybe not being as aggressive in their rate hikes. We're not only seeing that in the United States, but we're seeing it in Europe with the ECB, we're seeing it in Japan, we're even seeing it in China, where they're throwing a lot of money at their economy. So the equity markets love free money and very low interest, well, sure, and low interest rates. And so the Fed and central banks around the world are back to what they have been doing really through starting in 2009 with their various quantitative easing programs. So again, we're left with low interest rates and a Fed that is very willing to stand pat.
Yeah, and you talked about how great that has been for both the quarter, right, which was Q1, right, and then certainly too. I mean, so far in Q2, things haven't looked too bad either, you know, as we are a few days in. And that's what I really like how you kind of phrased the end of your commentary there about that's what they've been doing since 2009 as far as the central banks around the world stimulating, trying to get economies growing, trying to get economic data steady, trying to get maybe inflation numbers up off the deck. But here's what's interesting to me is now looking at the economic data landscape and how we kind of look at things within Kingsview and certainly at Kingsview Investment Strategies. Talk to me a little bit about how that economic data looks now from a standpoint of, say, GDP, employment, inflation numbers, and things that are out there that are kind of, I guess, mixed at best in our opinion.
And actually don't look great at all. But I think what we're seeing now is something that has plagued the economy really for the last 4 or 5 years. The first quarter has been the worst quarter, and they've picked up from there. So it is following script that we've seen over the last 3 or 4 years. And I think investors are anticipating that the second half of the year will be better. But the economic data really has been very poor, not beating expectations. So when you look at some of the surprise indexes, et cetera, they're all not doing well. GDP will probably run 2.25 or so.
Yeah, if we're lucky. Yeah.
If we're lucky. Retail sales are okay. But a lot of the data points right now, and certainly with the inversion of the yield curve that we just saw 2 weeks ago, now everybody's worried about a recession. And I think we're not going to see it this year. I think the risks are certainly much higher for next year. But that doesn't mean that you have to run away from the equity markets. Really, from now until probably third, maybe even into the fourth quarter, should be fairly good for the equity markets until we really start to see those signs of recession really picking up. We're seeing a few right now, a lot more than we did last year, but I don't think it's time yet to run from the equity
and having
markets.
the Fed at play now to be more dovish, as you mentioned, the running off of the balance sheet, which is stopping, and certainly the pivot that they made on not hiking rates any further, and maybe even a possible cut here, maybe towards the end of the year, maybe even in 2020. But you mentioned something interesting about expectations from investors. And one thing that we talk a lot about when we meet in our investment committee meetings every couple of weeks at Kingsview is the market psychology is so interesting these days, whether, I mean, at any time, but certainly now because of the fact, in my opinion, or our opinion, a lot of the data points, Paul, that were coming out, either pre-announcements from earnings companies or pre-announcements to earnings from S&P 500 companies, data overseas, expectations from CEOs, whatever it was, commentary about the trade wars with China. The psychology is such to where nowadays it seems like the market is able to take those things well, versus like in December or November, any whiff of a bad trade wind or something would knock down the S&P or the Dow, say 200 points, right? But now the psychology seems to have turned a bit.
And I think it has everything to do with the Fed. Because in December, November, as you mentioned, the data points were coming in poor, and it was investors were looking at the Fed as if they were tone deaf and not understanding what's happened to the economy. So now that the Fed understands what's happening and is very willing to back off, investors feel comfortable now that the Fed will step into the breach. And that's something that we have seen consistently throughout the last 30 years of the Federal Reserve. When we see these types of issues, the crash in '87, we see the financial crisis in 2007.
Gulf War, even in the 90s, yeah, sure.
The Fed would step in and ease monetary policy, whatever. It doesn't prevent the markets from going down, because we've certainly seen some big declines in the equity markets. But the Fed has become much more a factor in the markets, not so much the economy, but in the financial markets. So all the investors are always looking to the Fed before they put their buy orders in or sell orders in to see which side of the market is the Fed on here. But again, the economic data is going to lag, so the Fed has pivoted. We should see soft data probably for the next month or two. And if we do start to see things pick up, it won't be until May or June. If we don't see things picking up at that point, then I think we could be seeing a rougher go in the equity market.
Yeah, maybe, or a Fed that comes in and saves the day again, because you mentioned the Fed being tone deaf, with that, which I think is certainly an exquisite way to say it, because that's very true. But now I almost feel like Jerome Powell is sitting down at the piano and playing sweet music, because he's listening to the equity markets and playing to them to some degree. And also the bond market. I mean, look at what has happened to interest rates this year alone. I mean, 30 basis points down in the 10-year, thereabouts, maybe a little bit more, depending on the day. And this was all amidst that scare that rates were going to go to the sky, inflation was going to take off towards the end of last year. And now it's kind of almost like the bond market has led the Fed down to be more dovish. And I think, truthfully, too, in our portfolios, not being scared of interest rate sensitive investments like we had in the sector plays with real estate or utilities, some of the other things that were out there when it came to value, things that were basically taking advantage of, that depression in interest rates. Maybe we could talk a little bit about our interest rate outlook for the rest of the year, given that we have this conflicting data and now a Fed that is back in play, depending on how you look at it.
Well, one of the things that we take a look at is we take a look at the direction of interest rates, the trend that we see, and we pick that up in the utilities. We pick it up in commodity prices, and commodity prices on a year-over-year basis haven't made it above zero. In essence, they've been declining.
Emerging markets you've been featuring?
Those have been doing well. But again, when you look at the components for interest rates and interest rate outlook, the outlook for interest rates has been negative, meaning interest rates declining really for the last 4 months or so. And we think that can continue. The key to it is commodity prices. As long as the broad basket of commodity prices, not just oil, but all of the other ones, remain relatively flat, it's going to be very difficult for the Fed to raise rates, I believe, in the fact that you're not seeing the inflationary pressures. And I'm not certain that we're going to see them. We've had decent economic growth here in the United States without inflation, and we're not seeing the economic growth around the world. So it's going to be very hard to develop inflation. And so again, as a result of that, I think the U.S. is going to be stuck in this 2.25% interest rate environment for the foreseeable future.
Yeah, I think that's interesting. Yeah, and I think that's interesting commentary because, you think about global utilization of resources, which is not that high, especially the fact that resource acquisition is such to where you can get a lot of stuff pretty easily and cheaply, depending on where you're getting it from, but certainly the global economy has helped facilitate that. And the fact, too, I don't think we should get out of here without talking about the only inflationary pressures I've really seen so far in the last, say, 6 to 12 months, even, goodness, is the tariff-related stuff, right, which is not fundamental. I mean, that's usually a passing fancy, even though the trade wars have been kind of going on for over a year now, believe it or not. So without getting out of here too early, maybe we could tie this up with talking about how we feel about some of the geopolitical issues that are going on around the world, tariff wars with China and maybe Brexit, which appears to be maybe closer than it has been before, or not?
Yeah, Brexit is the on-again, off-again
relationship.
It is, and it's it's hard to quantify that one, but I think the trade talks are certainly having their impact on the U.S. economy, having their impact on China, certainly. It looks as though we're getting closer to a deal, and every time we hear that we're closer, you see the markets jump up maybe a 0.5 percentage point or so. So I think the markets are very tuned into what the economy and what is happening in the tariff wars, if you will. So we can see that continue for a while. If we get resolution, we can see probably a 2 to 5% jump in the equity markets once that deal is announced.
Yeah, I agree. And I think that the kind of the sum it up is, relatively unconcerned about interest rate movements. The Fed being back in play here as far as being dovish again and maybe supportive to these markets will definitely, I think, at least support equities here. And like you said, maybe some upside surprises here could lift equities back up to maybe all-time highs and so forth because of the fact we have a very accommodative Fed and a low inflationary environment. So things look pretty settled out. So great. I think, Paul, that's very good insight as usual. Thank you for taking the time again. Thank you for taking the time to watch this video today. If you have any questions or any comments, would like to get in touch with us further about talking about something more in depth about what we discussed today, please reach out to your Kingsview Investment Advisor. Thank you for joining us.